Welcome, everybody. Thank you for attending the Origin QOZ2 Fund webinar today. My name is Michael Episcope. I'm the co-CEO of Origin Investments, and I am joined with Tom Briney today, our Managing Director of Acquisitions in the Southwest. Tom joins us from our Denver office. He is our boots on the ground in the Southwest and one of our longest tenured team members, having been with Origin for nearly 12 years. He is a leader at the firm and a big reason for our past success. So I'm excited to have him here today. He is here to discuss our QOZ1 portfolio, our QOZ2 pipeline, and really provide insight as to what is happening on the ground. So welcome, Tom.
Thank you, Michael. I'm thrilled to be here.
I also want to welcome all of you here today. We have more than 500 people who have registered for this webinar, so quite a lot of interest in both Origin and QOZ investing. And we're here, we're going to answer all of your questions. Thank you for all the ones that were emailed in advance. We're going to try to keep this to under an hour as well. We might go over by a few minutes. I'm going to cover why Origin, give a little bit of an overview of QOZ law, talk about our strategy, and then hand it over to Tom to talk about our experience in development and the QOZ space. Also talk about the QOZ2 pipeline, which is really exciting. And then we're going to go over the fund terms and open it up for Q&A after that. So you can submit your questions along the way. I know everybody's familiar with Zoom. We've tailored these webinars so that we do answer all of the questions that have been emailed in advance. So hopefully, even those of you who have questions, those will be answered throughout the webinar today. So if you want to wait till the end, you can actually do that as well. Now, a couple of details I want to cover about the fund before we begin. QOZ2 is a carbon copy of Fund 1. It's the same strategy, the terms and team here, no different. We are targeting a $300 million raise. The fund will be open until we hit that target or until the end of 2023. I'm confident that we're going to hit that target first. We did start raising capital starting in October 18th, so it's open. Fundraising has accelerated quite a bit since closing Fund 1 and opening Fund 2, but we're nowhere near that $300 million cap, so you don't have to worry about that right now. Another, just piece of housekeeping that we get a lot of questions about is, can you take all my capital at once? And the way this fund has been designed is yes, when you are ready to fund, we do accept 100% of your capital at once. And it should be noted that in order for you to get QOZ benefits, you have to invest and not just commit. So it's when your funds are received. I'm going to start the presentation by spending 3 to 4 minutes about Origin. This is really for the benefit of new investors. I also know that we have existing investors here, and many of these things you've heard and are the reasons why you came to Origin in the first place. So let's begin the presentation. A little background, we've been around for 14 years. It was started with 2 investors, me and my partner, David. Today, we have more than 2,000 investment partners. We have 35 team members. We have 5 offices around the country. And the majority of investors who we serve are in the high net worth, the ultra high net worth, family office category. And our fastest growing segment is really the RIA space. So we have more than 32 registered investment advisors, wealth managers who use our various funds for their clients. So welcome to all of you who are here today as learning about our QOZ2 fund. It has been a great journey, and Tom has been here for much of that stretch, so he can attest to that. So 12 years, he was a young man when he joined the firm. When I think about Origin, there are really 3 pillars that differentiate us from other managers. And the first is alignment. And alignment is really about the goal being the same for everyone. And it extends from the investor all the way to our team. And it's really about generating investment returns, one thing. David and I sit in a very unique position, being both the manager and the investor. And alignment, it's truly important in terms of both what we do and how we do it. who we hire, how we compensate people, making sure that everybody in the chain is aligned. And I think it's a huge reason for our success as well. And I'm sharing this because it's one of the reasons why we got into the QOZ fund in the first place. David and I are taxable investors. All of our investment partners are taxable. And we discovered this program back in 2018. Well, what we found out is that we were already operating in QOZ areas in Fund 3. We were doing development as well, but we weren't getting any of the tax benefits because it wasn't a QOZ fund. So for us, it was really an easy decision to start QOZ1 back in 2018, 2019. And in that fund alone, David and I invested $11 million of personal capital. We've invested more than $65 million of personal capital across our various funds and deals. But it was, QOZ, again, back to creating products that we want to invest in for our own capital, because we are really no different than you, high net worth investors, ultra high net worth, who are looking for the best risk adjusted opportunities, and certainly measuring that on an after-tax basis as well. And QOZ just, there's really nothing better than I can think of. In this fund, we get asked this a lot as well. How much are we going to be investing? It's a little bit different than a market rate fund where you can use after-tax dollars. Well, I'll give you a range here. $5 to $15 million is my best guess, because what we're looking for in our personal tax returns are capital gains to invest. I personally put everything I could into QOZ Fund 1. I will also be contributing to QOZ Fund 2 significantly, but I can't magically manufacture capital gains. So there's a range there, $5 to $15 million. We are going to be investing next to investors in this fund as well. The second pillar I'll talk about is our ability to execute, and that's manifested in our track record. Preqin ranks us as a top decile manager for our consistent performance across our numerous funds. And one thing that I'm very proud of is that we've never lost money on a fund deal. And I think at our core, we are risk managers. That's what we consider ourselves. And we make sure we are positioning your capital and ours for success. We use moderate leverage of around 65%. We don't guarantee loans. We buy high quality real estate and we underwrite conservatively. And that's really been a winning formula from day one, and the formula that we'll continue to use when we're executing on every fund. Track record, though, is really, when you're looking at any firm, it's sort of a backwards looking indicator. And the question is always, can you repeat this? And there's two elements to that. One is the team and one is the market. And so I'm going to focus on the team right now because our team is our third pillar. And our leadership team comes from institutional backgrounds. They have been here consistently over, some more than 10 to 12 years. But it's really important to make sure that the team that got you to where you are today is going to be there in the future. Well, I've already mentioned Tom has been here for more than 11 years. Dave Welk, our managing director of acquisitions in the Southeast, has been here for more than 10 years. Our controller has been here for more than 12 years. Our general counsel for more than 6 years. Director of investments more than 6 years, so on and so forth. And longevity is important, especially in the world of QOZ. These aren't 2 or 3 year hold periods. These are 10-year hold periods. And you have to ask yourself when you're making this investment, whether it's with us or any other company, are they going to be around in 10 plus years? And I can tell you sitting here today, Origin unequivocally will be here in 10, 20, 30 years. We have built the firm to last. Let me jump into the next slide and we will start talking about QOZ investing. This one slide, I will caveat by saying I could spend an hour long on this. I'm going to go over this briefly. I assume that a lot of people have some basic knowledge of QOZ law. I would tell you that to be on the lookout, if you want a lot more detail about it, we're going to have a webinar in December. We're bringing on a legal and tax expert to answer all of those nuanced questions. So if your question isn't answered in the next 3 to 4 minutes or in the Q&A session, please be on the lookout for that webinar. So the first thing is what money qualifies to invest in a qualified opportunity zone fund and get the tax benefits. And the answer to that is capital gains. And capital gains can be from any source. They can be from stocks, bonds, real estate, limited partnership, cryptocurrencies, and it includes both long and short-term gains. Now, one of the questions we got prior to the webinar was investing through an IRA. You don't want to invest in a qualified opportunity zone fund with an IRA. That money is already tax efficient. There would be no benefit to doing that as well. And the other question we got is really about, is this a 1031 exchange? And the answer is no, but I would say it's the next best thing to a 1031 exchange. So if you've sold real estate and you have generated a gain and you're considering a 1031 exchange, this would be the next best option if you can't locate a property. So the timeline in front of you, I want to go over the three benefits. The first is the tax deferral. And what the tax deferral is if you generated a gain in 2021 and you invest that gain. So for round numbers, let's say you had $1 million capital gain in on your tax returns this year from selling anything. If you invest that gain in a qualified opportunity zone fund within 180 days, you will not pay taxes on that money until 2027. So you have to recognize that in tax year 2026, payable in 2027. So you can think about that as a low interest loan from the government, and you will be generating a return on that money. That's money that you couldn't otherwise use. And there's what we call the net present value to having that capital. The next benefit is a tax reduction, and that's only for investing this year. There's what's called a 10% step up in basis. So again, using that $1 million, if you invest in a qualified opportunity zone fund, when you recognize your gain at the end of 2026, you will only be recognizing a $900,000 gain at that time. If you invest in 2022, you will not get that step up in basis. So over the years, that step up in basis has gone from 15 to 10, and that's going to go down to 0. And the last one, which is the most compelling benefit, is the tax forgiveness. If you are in a qualified opportunity zone fund for more than 10 years in one day, you will not pay any gain on your investment whatsoever. So if that $1 million grows to $2 million, $3 million, $4 million, $100 million, it doesn't matter. 10 years in a day, you get out, you will pay 0 taxes. So it's a really compelling program. And the reason why this was created is to incentivize wealthy investors to invest in qualified opportunity zones, which ultimately invest in transitioning neighborhoods. It was a jobs program. So getting money off the sidelines, creating jobs, putting money into these neighborhoods to help transform them. Now, a couple nuances. I did mention you have 180 days from the realization of the capital gain to put it to work in a qualified opportunity zone fund. Partnership gains are a little bit more complex, but I am going to kind of get to the one date that really matters here. The most important date this year is 12/30/21. And that means that if you recognize a partnership gain in 2021, you can either invest that from 6 months from the date of realization or the last day of the partnership tax year. And the reason why 12/30/21 is important is because that still gives you that step up in basis of 10%. If you invest on January 1st, 2022, you will not receive the step up in basis for that capital. So it's a very important date. I'll caveat all this by saying, please consult with your tax attorney, your tax CPA, whoever it is. If they don't have knowledge around QOZ law, email us. We can get you somebody to speak with who knows a lot about this area. And I would also ask that if you're interested and you're sort of bumping up against that deadline, don't wait until the last minute. Our team is going to be working through the end of the year. You need to fill out your subscription agreements. You need to be approved. You have to get your wire ready, and then you can wire in on 12/30/2021. And we always have people scrambling. We will do our best to accommodate you. Another thing I want to say about this, which is really great about the law, the way they've devised it, is that you still get all the great benefits of investing in real estate. So you get depreciation, you get the ability to refinance tax-free, none of that has been stripped out. So this is going to be a tax-free investment for 10 years, and you don't have to worry about any of the yield that the fund is going to produce in generating taxable, because there will be plenty of depreciation along the way. And the other thing I want to say is that, for many investors, we also get this question about paying taxes, right? Are you paying based on this year's tax rate or the tax rate in 2026? And the answer is the tax rate in 2026. So there are a risk to everybody that taxes are going to go higher. But even in the face of rising taxes, you have to consider your money is being put to use. So you have that 6 years, and that your money is earning a return over those 6 years. Plus, the benefit of tax forgiveness outweighs the impact of higher taxes greatly. So when we do the calculus and we run the math, the kind of after-tax wealth created by investing in a QOZ fund is generally 50 to 75% more wealth. And when you think about it logically, if you believe taxes are going up to 30, 40, 50%, I'm not opining, I'm using that as an example. The fact that there's forgiveness at the end makes the benefit even that much greater. For me, like when I'm looking at this, capital gains, if you have them, it's really hard to consider anything other than a QOZ fund. Let me jump into the fund strategy here next. So the fund will be investing 100% in multifamily in what we call build to core. And what that means is that we are developing a Class A portfolio of properties that is meant to be held for a long duration. So we start with development and we move on to really a stable core portfolio of multifamily properties that are diversified across geography. QOZ law, it requires that we make substantial improvement of the properties. So no matter what QOZ fund you're looking at, it's likely to be engaged in ground up development. Why we choose multifamily, because, really two reasons. Number one, it's what we're good at, what we've been doing for years. But more importantly, it's because it has historically generated the highest risk-adjusted returns across the real estate sector. And when I look at this today, this isn't something that will be disrupted by the virtualization. And in fact, the markets we're in, they're only going to benefit. And we've seen the demise of retail. We've seen the demise of office over the last couple of years. And so, I would say the last two sectors that are really safe, and maybe there's three, you're looking at industrial, you're looking at multifamily, maybe self-storage, a little bit of a niche product there. But historically, we invest in multifamily for the two reasons I already named. Once developed, property, I think I mentioned this, I just want to mention it again, it will be around 10 to 12 properties diversified across geography. And the returns that you see, these are all net of fees. We're forecasting generally a 10 to 12% net IRR. And by the way, that's over a 10-year period. So you have this kind of push and pull between IRR and multiple. And certainly the longer you go out, the lower your IRR becomes, but the higher your multiple is. And our multiple is about a 2.25 to 2.5 multiple. And I say that's that's kind of our base case. And we did good questions. How is this going to be different than Fund One? And I'll just say that, forecasting returns over 1 year is difficult. Over 3 years is difficult. Over 10 years, it's even more difficult. And we have slightly tempered these returns from what we were showing in Fund One. The reality is we don't know what the future holds. But there's two things I think about here. Number one, we underwrite conservatively. Historically, when we've been wrong to the upside, meaning that when we are looking to generate a 2x return on a deal, if we're positioned right, it might become a 2.5 or 3. On the other side, if we're wrong on the other side, we're hitting a 1.5, a 1.6, a 1.7. And so, this fund, it could easily hit a 2.5, a 3, a 3.5. Our job is to put your capital and ours in a position to win. And that means picking the right deals in the right cities and being able to withstand economic shocks along the way. using non-recourse debt, putting a lot of equity into the deals as well. The second thing I think about here are really looking at the market and development margins. They're still incredibly strong today. And our pipeline that Tom is going to talk about is second to none. A lot of deals that I'm really excited about. One of those deals will be shared between Funds 1 and Fund 2. And I'll just finish with this on this slide. Whatever the upside is, we will capture it. Could be that this fund delivers, much more than what you're looking at in front of you. But more importantly, we're going to minimize the risk of loss along the way. Let's jump to the next slide. Let me just talk a little bit more about our fund strategy. What you see in front of you are the markets we are targeting. We are in low tax, business, and climate friendly states. These are the cities that really have the most favorable outlook over the next 5 to 10 years. And these states have been winning population growth from the northern states for 3 decades, 4 decades. And COVID has only accelerated that trend, and it's going to continue. The virtualization of the workforce is here to stay. It's not going anywhere. We've all seen it, across our cities, wherever we are. The other thing unique about our strategy, which I want to talk about, it's not just the markets we're in, but why we're in these markets, and it's our predictive model. The growth rate in any financial model is arguably the most important variable. If you plug 2% into a model, it's going to give you a very different outcome than 5% when you're looking at revenue growth rate. And that could be the difference between doing a deal, not doing a deal, making money on a deal, losing money on a deal. And for years, we rented what was out there. There are other organizations that sell data. They sell growth rates on cities, on properties, on submarkets. But when we back tested it, it just wasn't accurate. And we didn't feel we could rely on it. And it's such an important part of investing that we set out to build it ourselves. So about 2 years ago, we hired 2 data scientists from the University of Chicago to build a predictive model. And what we wanted to do is kind of take this intuitive knowledge that was in our head and all the variables that we know that operate to make cities grow and what makes real estate great. And they've spent the last 2 years doing that and getting in Tom's head and Dave's head and Mark's head and really bringing this into this predictive model that uses a form of AI to calculate growth rates at a city level, at a submarket level, at a property level, to make our job just that much, I'm not going to say easier, but it augments what we already do, because a lot of this is relationship driven. But when you're looking at growth markets, and you can see a market like Phoenix that has a growth rate of 6% for the next 5 years, and we can get into deals and make them work at growth rates of 2.5 to 3% in the model, we feel really good about that. And we feel like we have a lot of room to run and a lot of upside. So our model, it's proven to be incredibly accurate in identifying markets where we should be and where we shouldn't be. And that's kind of, just back testing, looking at all our cities, just making sure that we are in the right cities and that we are prioritizing where we should be. Tom's going to probably expand on this in a little while. So let me, I'm going to go on to one more slide, and I'm going to talk about cash flow, because this is always a big question we get from investors. And so when you think about the life cycle of a development deal, it's just under about 4 years. It takes roughly 24 months to build the project and another 12 to 18 months to lease and stabilize the property. And then after that, there is a refinance. So what you see in front of you is the development period. You see the lease up period, and then you see the refinance, which really happens anywhere between years 3.5 and 4.5. This is a little conservative here. It shows year 4.5. And so at that refinance, we anticipate sending back about 20 to 25% of the invested equity from that project itself to investors. Now, I'm going to caveat that by saying there is a law within QOZ. So we cannot return equity to investors within 2 years of the last investor coming into the fund, or else it is considered a return of equity. So even in Fund 1, we just closed that fund a month ago. we cannot return equity to investors from properties they're going to be refinancing in the next year until after that 2-year anniversary. The same would go here. The same would be true here. But the nice thing is that if we invest all the capital by the end of 2023, we will be on pace to deliver all refinancing proceeds by the end of 2026. So you have funds to pay your taxes in 2027. The other thing to note, we're going to have a stabilized portfolio of Class A properties that will generate about a 6 to 7% yield on those on your invested equity. And so, all that, the appreciation, the refinancing proceeds, the yield on your equity all generate that kind of 2.25 to 2.5 net multiple on your invested equity. And I should mention that when I quote that is not factoring in the tax benefits. Your tax benefits happen on your end. Those would be on top of that. So thank you very much. I'm going to hand this over to Tom right now to talk about our development experience, the pipeline of Fund 2, and then go over the terms, and then we'll open it up for Q&A. So Tom.
Thank you, Michael. Appreciate it. This is the summary of QOZ Fund 1. It really summarizes our experience within the fund and the pipeline to wrap up what is currently our first Opportunity Zone fund. As you can see, we've got 3,700 units, about 265 million of equity deployed across 11 projects. I'm extraordinarily proud of what the team has been able to put together within this fund. It's the 11 projects span all of our growth markets. The AI platform that Michael mentioned earlier really suggested that these are the growth markets that we would have the most success in, and our boots on the ground experience said the same. And the diversification that investors get here, both from a geography standpoint, a deal count standpoint, and a sponsorship standpoint, are second to none. The investors here, and that really allows us to protect the downside from these investments. As Michael noted earlier, we're risk managers. Our objective is to first protect the gains that have already been made by our investor base, and secondly, to grow those gains for the future. With this diversification, with the quality of the sponsorship that we have in this fund, and the diversification, I have no doubt that it is extremely protected from a loss perspective and has a tremendous amount of potential to grow in the long run. Fund 2 will be an absolute carbon copy of the strategy of Fund 1, boots on the ground and diversification. So Jeff, let's see Fund 2 real quick. One of the questions that I get now that we've been investing in QOZs for 3.5 going on 4 years is, are the opportunities played out? Are there still good QOZ deals out there today? And the answer is unequivocally yes. There are still plenty of opportunities for us to invest in opportunity zones going forward. And the reason is twofold. One, the markets are always moving, right? And we aren't investing in markets that are static, that are lacking growth, that aren't seeing the growth that we are seeing. So because we're investing in the Nashvilles, the Atlantas, the Phoenix, the Colorado Springs, these are all very high growth from a job growth, from a population growth perspective. And because of that, what used to be a challenging micro market 5 years ago is budding into a new potential high growth micro market within a city. And a perfect example of that is Colorado Springs. As Denver became more expensive, as jobs became higher paying in Denver and less advantageous for the employers, they started moving jobs to Colorado Springs. And we saw that very early in the process. If you noted in Fund 1, we have 2 deals in Colorado Springs. In Fund 2, we'll have at least 1 more deal, if not 2 or 3 more deals in the Colorado Springs market. And that's an example of us being in the markets. I live in Denver. I'm in Colorado Springs frequently. I'm in Phoenix all the time. And I see that transition happening before other institutions see it. And it's been really fun to watch that as we go into these markets, as we dip into Phoenix or Colorado Springs, 6, 12, 18 months later, you'll see the really big players come into those same markets. And that's one of the challenges that we're seeing with QOZ Fund 2 pipeline is we're not just competing with other QOZ funds at this point. Because we're early identifiers of those new path of growth opportunity zones, shortly thereafter, the Prudentials, the Carlyles, the JP Morgans are coming in with non-opportunity zone dollars. And they're competing against us for those same investments. One of the advantages that we have that has allowed us to build this pipeline, which totals about 220 million of equity, just under 700 million of total project size, about 3,500 units. The way we've been able to build that pipeline before we've even really begun raising the capital is because we are experts in the space and we've built these partnerships already. So many of the partners that we've done deals with in Fund 1, we've built a relationship over the last 3, 4, 5 years, and we continue to build that relationship into Fund 2. And that spans back to Origin Fund 2, Origin Fund 3, all of which have development components to them, and going on to Origin Growth Fund 4, which will launch in January. A lot of the sponsors are top tier, best in the country, best in the region, and they find the top opportunities in these path of growth micro markets. Because we've got a relationship with them, they come to us first and say, Origin, we've loved what we've been able to do with you so far. You are competitive in every way, and you've got great ideas, you've got great technology, and we want to partner with you some more. So not harping on Colorado Springs, but that opportunity is with an existing partnership that we've done 3 other deals with. And they said, this is a deal that needs to move quickly. It fits in an opportunity zone. We want your advice, your expertise, and your knowledge in this micro market. Are you interested? And it was before they had all their plans complete. And so that really, that early opportunity to look at deals with existing partnerships will help us to continue to fill out this portfolio. Again, this is 200 million of equity. We're targeting 300 to 350 million. I have no doubt that we'll be able to find the right deals in opportunity zones going forward because of our boots on the ground, our AI program that Michael mentioned, and our existing relationships. This is shaping up again to be a carbon copy, as Michael mentioned, of Fund 1. It is top tier markets, top tier developers, and really strong diversification for our investor base. So let's jump real quick into the terms. The terms of the fund will be the exact same as Fund 1. As Michael mentioned, the fundraising and deployment will occur through December 31st of 2023. So for those investors out there, you've got 25 months, just under 25 months to either realize your gains and invest them, or make some gains, realize those gains, and then invest them. I would note that we are raising capital quickly. The end date is December 31st of 2023. In the event we hit our cap of 350 million before that date, we will stop raising prior to that date. The other piece that I wanted to point out is the upfront and one-time setup fee. So this will be aggregated for investments between Fund 2 and Fund 1 and Fund 2. So for example, if an investor in Fund 1 invested $200,000 and paid a 2% fee, that same investor comes into Fund 2, invests a second $200,000. Both the Fund 1 and Fund 2 fee will be treated as a $400,000 investment and that lower 1% fee. Everything else is the same. And so I will pass it off to Michael for next steps.
Great. Thank you, Tom. And I should also note that the admin fee for anybody coming into QOZ2, if you come in at $100,000 and then later on increase your investment, we aggregate that. We look at it as a whole, not individual investments. And so, you know, the way our admin fee works is this is sort of a cliff, right? So if you invest $400,000, you're at a 1% level. And if you invest $100,000, you're at a 2% level. So we do look at that. Now, one nuance I'll say that we're changing is that we're not doing admin fee credits anymore. So if there was a situation where you increased and there was a credit because of some, you know, you wound up in this weird bracket and you already paid too much, we're not doing a credit. It's too difficult on our IR team, on our accounting team to manage those across all of our funds. But what we do is the next investment will be the lowest possible. It'll be zero until you catch up to the appropriate admin fee on that side. So I just wanted to add that. That is a new change that we will be announcing for our program. So let's jump into Q&A. I actually went over all of the questions that came in before, and it looks like we hit most of those. So I'm going to start with the Q&A. I'm going to start with the ones that came in the earliest. And the first one is from Alex. Alex, thank you for your question. He asked if non-capital gain assets are invested in a QOZ fund, or if assets are placed in a QOZ fund after 12/31, does this investment still benefit from the 10-year hold? The answer is no. Non-capital gain assets do not benefit, do not reap any of the benefits under QOZ law. If you have capital gains and you invest after 12/31/21, yes, they do benefit. The only benefit that goes away is the step up in basis.
I will jump in and answer a question from Anonymous that asks if we can compare across some other opportunity zone funds and what makes us different. And that's a really interesting question. There aren't many opportunity zone funds out there of scale. And I would qualify Origin as scale. And there's a couple that are bigger. And the nuances between us and those larger and smaller funds are this. The larger funds don't have the ability to develop the relationships that I mentioned earlier in some of the slide presentation. Because it's really just one group that has a multi-billion-dollar fund. Because it's so big, they're taking deals that they can get regardless of some of the risks that might be involved in that sponsorship team, in that micro market, and they're really more of a volume shop rather than a quality shop. That gets you tremendous diversification, but it also takes on bigger risk. And what's been really interesting to watch as an individual who's sourcing these opportunities, a lot of the ones that we pass on are absorbed by some of those other groups. We don't like it because of sponsorship or because of location or basis or whatever the case may be. A lot of times those larger funds, those one or two larger funds, will take those assets because they need to put the capital out. And that's very specific why we're keeping our fund limited in size, is so we don't have the risk of taking on deals that we don't believe in, that we wouldn't put our own dollars in. And on the opposite side of the spectrum, there are countless funds that have one deal in them. And as I mentioned in Fund 1 and Fund 2, we have a tremendous amount of diversification from a geography perspective, from a sponsorship perspective, and that really allows us to mitigate the downside. If you're buying into or investing into a singular asset fund, you have huge risk to that particular asset. If something doesn't go right in a micro market, if that individual or that group missed something major in that market, which happens, you're exposed a lot of capital to a single deal. So I think that we're perfectly balanced, in my opinion, between size, being big enough to get diversification, but not so big that we have to take every deal that comes across our desk.
I'm just going to add to that, Tom. I would implore any investor who's considering us to also look at the landscape. And I talked about the 3 pillars of Origin that make us different. I mean, ultimately, you have to decide if what you see in front of you is the best in the market. I believe it is, but that's really something that during your due diligence, you'll have to make that decision. Next question is from Alex. Can you discuss how this fund will be different or the same from the growth fund that will be launched in January? Alex, good question. The difference between this fund and that fund is that this is QOZ. This is only investing in qualified opportunity zone projects. The growth fund that we'll be launching in January is market rate development. So, I'll just, jump in here because we've had a lot of discussions about this. And when we're talking to other sponsors out there and we're trying to tie up qualified opportunity zone projects, they also have market rate development projects, which are also fantastic. And when we want to do repeat business with sponsors, we have to be a solution across the spectrum. But the other thing is that when we think about investors, not everybody has capital gains to put into a qualified opportunity zone fund. And when we're creating funds within Origin, well, we have the Income Plus Fund, which is sort of a low to moderate risk. And so some people don't care about income, they only want growth. And so that's the genesis of the fund that's coming up. Growth Fund 4 is fitting into kind of what the market, making sure that we can solve problems there, but also giving our investors a project or a fund that they've been asking for.
I'm going to knock down 2 at once here. They're both related to the co-invest that Michael mentioned on early. One asks, there was a $7 million co-invest in Fund 1. What does it look like in Fund 2? And what's the minimum that they're talking about in Fund 2? As Michael just mentioned, in order for both Dave, Michael, and employees, because there are employees in Fund 1, there will be employees in Fund 2 as well. To invest in these funds, there has to be gains. Michael mentioned a $5 to $15 million investment, depending on how gains occur for him and Michael. But there will also be investments from the employees of the firm. There isn't a specific minimum, but I'm confident in saying that those investments will happen, and they'll be alongside paying the same fees and having the same structure as everybody else.
This question, I don't want to push Pender, I think is the name here. I have capital gains from an LLC which had passed 180 days in September, and now I have only options to invest on December 31st. How can I commit for the same on December 31st? So it's very easy. Number one, you can reach out to somebody in investor relations at origin.com, origininvestments.com. Sorry about that. And somebody will get back to you. And I see here you have reached out to somebody. They haven't gotten back to you. We do pride ourselves. I think we have a great investor relations department. They are really doing what they can to manage the demand right now for QOZ2, a lot of the questions. So I would say just ping that person again, or shoot me an email, and I'll make sure that it gets run up to the right people. Michael at origininvestments.com. You know, one thing, when we talk about Origin, one of the differentiators is our accessibility to our investment partners. So anybody who ever, you know, has a question about Origin, wants to talk real estate, or has maybe a way that we can improve as a company, feel free to email me directly. I love to hear from investors. Thank you.
Working up from the bottom a little bit here. The question, which just disappeared, was, does Origin provide the opportunity to invest in individual assets, or must you invest in the fund? In QOZ Fund 1, there were opportunities for fund investors to invest in sidecar opportunities. However, we do not provide an opportunity to select which deals you want to invest in and which deals you don't. You invest within the fund, and you'll be exposed to all the fund assets. And in the event that we have a sidecar opportunity, fund investors will be provided the opportunity to invest in that investment first, but there is not an opportunity within the QOZ fund to elect which deals you're in and which deals you're not in.
This question is from Connor. Is the income generated from the QOZ fund tax exempt? It is. The income will be shielded by depreciation. I had mentioned this earlier. Like, one of the greatest benefits about the program is they didn't strip out any of the great benefits for why you invest in real estate in the first place. So once these properties are up and built, depreciation will start, cash flow yield will begin as well. And by our math, we won't be paying any taxes on any of the what I'll call cash flow in the first 10 years. And we will be using accelerated depreciation to the maximum extent as well.
This keeps moving on me. The question was, is QOZ Fund 1 meeting your expectations so far? And I would say yes, not only is it meeting our expectations, but it's exceeding our expectations. We have only 2 projects that are in lease up. Admittedly, they're far exceeding my personal expectations for the fund. And the assets which we have started developing, partially because one of the advantages and one of the challenges that we have in QOZ Fund 2 is costs continue to move. Construction costs are moving up, and they're very volatile right now. We're seeing it across both our QOZ funds and our non-QOZ development funds, and they're very hard to nail down. The plus side is, in the markets that we're in, they're all very high growth from a rent and job and population perspective, which is driving future rent growth. The nice part is, for QOZ Fund 1, the costs have been locked, and we are developing with costs that are known. And therefore, the benefit of that fund is generating locked costs, but increasing rents and increasing valuations. So Fund 1, I think, is exceeding our expectations. And I would say that I would expect, at least in the near term, Fund 2 to do something very similar. We will lock the cost of the projects as soon as we can. We'll buy out the contracts from the subcontractors. We'll start building. And the markets that we're in will continue to grow. They're extraordinarily tight from a supply-demand perspective. I would expect rent growth, although it's been extraordinarily high in 2021, to continue at a very accelerated pace in 2022. And we should continue to see the same development benefit in QOZ Fund 2 that we're seeing in Fund 1 now. It's important to note, as Michael mentioned, that we don't underwrite that kind of growth. We are very strategic in our underwriting, making sure that we mitigate that cost escalation, and we take that into account in our underwriting, and we do not take into account the rent growth that we're currently seeing. So we're really pretty punitive in our base case underwriting from a cost and rent growth perspective, and I would expect Fund 2 to perform extraordinarily well as well.
So I'm going to answer two questions from Anonymous. One is, can I invest in QOZ all my capital gains from any source other than real estate, such as stocks? The answer to that is yes. The other question that came in, it appears that most of the expenses are open-ended. That is, no numbers or percentages associated with them, development fee, construction management fee. I'm not exactly sure where that's coming from, but I will say that when we evaluate an opportunity, we are the ones who are negotiating all of the market rate fees for that development. So we do joint venture with sponsors on the ground, and I can tell you that we do a really good job of skinning them down to what is fair. So we understand what market rate development fees are. We understand what property management fees are, construction management fees, what all the reasonable fees are in here, because ultimately the property will only produce so much, and we have a cost of capital, and we need to make sure that every deal meets our cost of capital, but we're also being fair to our partners on the ground, because somebody's not going to work with you if you're trying to squeeze them and put them under market at every place. I should also mention that those aren't fees that we as a manager take. We are in the business of investment management, asset management, so we are a layer above. And what we talked about earlier was that this is a carbon copy of Fund 1. So the fees are listed out in the PPM, what we charge, the annual asset management fee, the acquisition fee, and then the other like placement fees and things like that. So if you have any more questions about that, happy to go over with you. But those those are not only detailed in Fund 1 or Fund 2, but you can also kind of look at Fund 1 and see what fees were charged within their operating expenses, any fund placement expenses, which we had none. So thank you.
And I'll continue on the fee front. Just a clarifying point from Aaron Brown. Is the 10 to 12% net include the 1.5% management fee? The answer is yes. And I'm going to jump into a second question to give Michael a breath of fresh air. Is it multifamily at a peak, from John Mako? That's a great question. Pricing for existing assets is as high as it's been in my career, and I think as high as it's been in anybody's career. So is it at a peak from an existing perspective? Yes, pricing is extraordinarily high on a per unit basis, which is what makes this fund so attractive, in my opinion. What hasn't gone up as quickly as the pricing for existing product is the cost to build new product. So that spread between existing product and the cost to build new has never been wider either. So when we have the opportunity to either pay, and I'll use a round number, $300,000 per unit for an existing asset, or we can build brand new product at $240,000 per unit, wouldn't you rather build new construction at $240,000 per unit? To me, the answer is unequivocally yes. I would much rather build than buy right now. And that's what makes this fund so attractive, as well as our Income Plus fund going forward so attractive, is that spread, the margin between where you can build and where you can buy. I think a better question perhaps is it at its peak? From a valuation perspective, it's very high, yes, but so is demand. I was in Salt Lake City yesterday at a conference. In Salt Lake City, which is a target market of ours, has been at 98% occupied from a renter perspective, been 98% occupied for the last 5 years. They cannot build the product fast enough. So yes, pricing is very high, but it's a function of demand. And we are solving some of that demand by these opportunity zone investments. So yes, it's very high, but I like the opportunity.
Tom, I'm going to just opine on that as well, because there's a couple of things. Number one, I mentioned why we're in multifamily. It's best risk-adjusted return in real estate. Over a 10-year period, multifamily has never lost money, institutional multifamily. That doesn't mean individual deals haven't lost money, but our strategy, I believe in it, the cities, the growth, you want to put the wins at your back. And if we go back to 2007, if you were in multifamily in 2007, arguably the worst period, right, for real estate, 5 to 6 years later, you were back at a point in time where you were at least back to even, if not above it. And then you couldn't recreate those prices anymore at years 7, 8, 9, 10. So even if you bought at the peak in 07, by 2017, you were up quite a bit of money in multifamily real estate. And that's what I love about this fund, is that it is long dated. It's 10 or more years. You can stay in for 10 years, you can stay in for 20 years. And we want to think about buying great real estate and holding it forever. And one thing we know is that in 10 years, real estate, the replacement cost will be far more expensive than it is today. And in 10 years from then, it'll be more expensive, because if you go back in history, every 5 years, real estate is more expensive to build than the 5 years previous. And that's not going to change, in my opinion, going forward. These are some quick questions I want to go over just about tax dates. When does the 180-day period end for a single owner LLC? Phil, the answer to that is I don't know about a single member LLC. I don't have that question. Please email us offline. You can email investor relations. We'll try to get that for you. The other question is from Rob. Is there an additional capital call provision in the fund? And the answer to that, Rob, is no. You are a limited partner, and whatever you invest, there are no more capital calls. And take you back, when we first were concepting Fund One, we were actually going to make it a capital call fund, but we got so much feedback from our investor community that when people have gains, they have to invest them all at a certain date. So we constructed the fund to be able to accept all your funds at once, but there are no capital call provisions during the life of the fund.
Anonymous asked, what two things worry me? That's an interesting question. There are certain things that keep me up at night, and it changes depending on what's going on in the capital markets. The capital markets is one of them for sure. The cost to build new construction keeps me up. Will the rent growth in the markets, will the cap rate compression keep up with increasing costs? Can we get the labor to build the project? There's 1,000 things on every development deal that can keep you up at night. Where I get comfort is our market selection, our micro market selection, and our partnership selection. All of these things are highly vetted. Our partners go through a stringent diligence process. We enact a stringent diligence process on our partners. Many of them are household names that you would recognize if you're in the real estate industry, that have dozens of projects being built every year across the country. They're the best of the best. And that substantially helps mitigate things that you can control. The things that you can't control, you just have to put yourself in a position to win. And that is conservative underwriting in markets that have the highest probability of growth. So there's 100 things that worry me every single day about every single project, but I think we do a really nice job of mitigating those things which we can control.
I would actually answer the same way. And it's really about not two things, but it's the difference between what's controllable and what's uncontrollable. And when we went into COVID last year, it was, when you go into a crisis, there's not much you can do. It's all the decisions you make prior to the crisis that matter. And I think we do a really good job in that department of making the right decisions, the risk management, the way we underwrite. The things that keep me up are the things that we can't control, the things that Tom mentioned, interest rates, macroeconomic shocks, what's happening in the rest of the world, the government debt, right? We could bury our head and we could just, kind of go into this hole and worry about all these things. But, there's only so much we can control, but those are the things that I worry about. And when we think about underwriting, well, if we're worried about interest rates, well, how do those show up in the underwriting? And in all of our underwriting, we underwrite to higher interest rates in the future. We just simply plug in the yield curve. How does that manifest itself in cap rates? Because the cap rate is the multiplier to income. Well, we underwrite higher cap rates in the future as well. And this is why what I was mentioning earlier, in a world where you have falling cap rates, why we've outperformed, because when we were doing deals 4 or 5 years ago and cap rates were to 5 and our exit strategy assumed a 5.5, and then they were at a 4.5, we outperformed significantly. And what our underwriting really does for us by adopting these institutional standards is it weeds out the average deals, the deals that can't withstand any economic pressure whatsoever. So it's a great question. And candidly, I do worry about a lot of stuff, but the things that I can't worry about, it's hard. So you try to make the best choices you can along the way. And I hope that the next 10 years looks like the last 10 years, but if they don't, right, and we get a blip or a recession, we're going to be well positioned. Let me ask Anonymous, I think there were a couple questions. Will there be K1 statements yearly? The answer is yes. We actually did not decide to do this in a REIT structure. We had a long conversation about this. A REIT adds complexity, and there's actually not a lot of benefit of doing this to the investor, right? The trade-off is that you will get state K1s, all right? The good thing, though, is that you will be getting a lot of accounting losses that flow through to those K1s. So when we are doing accelerated depreciation, if we had a REIT, the REIT would capture and hold all those losses, and those would not flow through to the investor. But because we will have all these accounting depreciation losses, everybody will see a lot of losses show up on their K1s as a result. So there will be K1 statements.
Anonymous out of Dallas asked, he sees we have a Dallas office. He lives in Dallas, and he's wondering why there's no Dallas opportunities or Texas opportunities in QOZ Fund 2. As I mentioned earlier, that the pipeline that I was reflected on that slide is not our entire pipeline. We see literally dozens and dozens of deals every week, some of which make sense to dig into, some of which don't make any sense to dig into, and a fraction of those are in qualified opportunity zones. Dallas has a tremendous amount of growth. If we have the opportunity to invest in Dallas in an opportunity zone, we absolutely will. We have some in the pipeline that we're digging into now. We just haven't quite had one far enough along to report on and suggest that there will be a deal there. So we're actively trying to source in Dallas and Austin. And we've been successful in closing deals in both of those markets recently. They just happen to not be for QOZ Fund 2. So we'll continue to be active and we'll hopefully get something done in Dallas and Austin in this fund.
This question is from Bill. I'm going to answer 2 in a row. Are you able to sell a property and then reinvest into another property? And Bill, the answer is yes, under QOZ law. I believe you can do that within 12 months, but that's not part of the strategy of this fund. We're building a portfolio and we're going to be holding it for the long term. The other question, what about REAs? Do you combine all of our clients to get a higher break-even point? The answer is yes. We have specific programs for REAs and their clients. So please contact somebody in investor relations, or you can email me and I will point you in the right direction. So last one, Tom, maybe you can take this too, and we'll kind of do this together, because why Chicago?
I think Chicago is a unique animal in that, we're not necessarily targeting investments there today, but it is such, it's our market, right? I think all of us have lived there, even in our regional markets now, myself included, have lived there. We know the markets intimately. We've invested there in the past. And sometimes there are opportunities that come across because of the relationships that I mentioned earlier, in conjunction with support from data, that makes sense to invest in Chicago. We did one investment in QOZ Fund 1 in Chicago. We are not actively seeking deals in Fund 2, but when the right relationship says, I've got this deal that's too good to pass up, we take the time to look at it. And I think that that's the prudent thing to do, to make sure that we are finding the best opportunities for our investors.
That's right. And more, most importantly, what you said there is it's not a target market for QOZ2. We like Chicago, but candidly, there are better markets than Chicago to invest in right now. And you can't ignore the fiscal situation here today. And so, if we get more visibility on that, then, we could change our minds. And it'll also depend on what our predictive analytics tell us about this market. It's interesting though, we own several assets here, and we've done quite well in Chicago from an investment standpoint. It's been one of our best markets over the last 10 years because of what Tom is talking about. Real estate is relationship driven, it's block by block, it's idiosyncratic risk. And when you can find big edge in a market, you take it. And so we've done very well here. So we're not, completely counting it out, but it's not a place we're spending a lot of time in right now because of the fiscal situation.
If we have time, I'll keep answering a little bit here. One question relates to inflation and hedging inflation. Real estate, as we know, is an inflation hedge inherently, because the cost of developing new product continues to go up. Through the cost of inflation, if rents don't keep up, then new product will no longer be delivered, and then rents will increase behind that because there's a supply and demand imbalance. I think more importantly to think about from an inflation perspective is what happens to interest rates. And this is something that we have a lot of discussions on internally. It seems like daily, but maybe it's every other day. And we're doing a lot to try to mitigate the risk of interest rates increasing over time, especially in a longer dated fund like the QOZ Fund 1, QOZ Fund 2. There is interest rate exposure during the development period. Now, we mitigate a lot of that interest rate risk through purchase of caps and swaps during the construction period. We're also exploring hedging, buying future hedges to mitigate the risk between the development period and the permanent financing period. So if interest rates go up between now and when the construction is complete, we've got some of that interest rate risk hedged. And then finally, when we complete the project and we refinance, we're refinancing oftentimes with long-term fixed rate debt. That allows us to take that risk off the table to allow our project to benefit from the inflationary environment while mitigating our risk and our expense on the debt side, on the leverage side. So we are very active in conversation and analysis to make sure we have the inflation risk mitigated as much as possible.
And we have time for maybe a couple more questions here. I'm going to answer this from Chris. Chris asked the question about really the PPM and how chargebacks work from the company to the fund. Are all the employee costs paid from the top revenue essentially? Chris, the answer to that is yes, but there are always exceptions to the rule. So the rule is that if we are doing something in-house that's kind of outside the normal practice of launching a fund, then we charge those back. So for example, typically when you're creating a fund, you would go to outside counsel, they would create the fund documents, they would do all that. That would be an expense to the fund itself. Well, we insource our general counsel and our legal, so those are charged back, but they're charged back at a below market rate. And the reason why we do that is for, number one, quality control and cost as well, because candidly, we can do it cheaper and faster than outside counsel can do. And we always have outside counsel, especially in QOZ law, look it over, but a charge like that would be expensed back to the fund. But Tom's time, the acquisition team's time, those are not charged back to the fund. The investment management team's time are not charged back to the fund. But if we are augmenting something like the fund admin money that we would have paid them, then those would absolutely be charged back to the fund as well. So I hope that answers your question.
There's an interesting one here about real estate syndications, and it's not necessarily related to QOZ, but in general, it says, I've seen quite a few real estate syndicated funds go belly ups, comments as to where they fail. And I think that speaks volumes to two things. One, being in a diversified pool, a fund that gives you diversification against 10 to 12 assets, against, at least as many or almost as many funds or deal sponsors, developers, development partners. It really speaks to the diversification component of it. The other thing that really piqued my interest about this question is we see it a lot too. We see it on both from our competitors and some of the national, the CrowdStreets of the world, where the deals are syndicated to individuals for $5,000, $10,000 a piece, whatever it might be. A lot of those deals, which end up in those other syndications, are deals that we have seen as a firm, as a deal sourcing team, and have passed on for a number of reasons. again, we have a very stringent underwriting policy. We're very conservative. And as Michael noted, the way we underwrite, it eliminates the probability of a deal that goes sideways because of the most nominal shock to the macro environment. We have a conservative underwriting process. And a lot of times, once we've gone through the process and rejected a deal, several other groups may also reject that deal. And it becomes a syndication perspective where those are the deals that oftentimes aren't quite as strong. They're a little bit more on the margin. They're sometimes a little bit higher leverage. Maybe it's the sponsorship. They're all a little bit different. There's no good one reason as to why they fail, but they're oftentimes deals that we have seen and have chosen not to pursue.
Tom, we're getting over here. I'm going to answer from one more investor, John. John has several questions, so I'm going to get these, and then please answer one more, and then we will conclude the webinar. John asked, are there going to be annual valuations? The answer is yes. We actually do quarterly valuations, John. And then investor portal for reports. Absolutely. We have investor reporting. We do these webinars on a regular basis for funds that are even closed just to update investors as well. Please compare to industrial and storage. That would be an entire webinar, John. I would love to do that. We don't have time here today for that. And is there any recapture of depreciation upon sale? And the answer there is no. There is no recapture, which is one of the reasons why we will be using accelerated depreciation in this fund.
I'll answer one more from Charles that I'm going to qualify as being relatively complicated, but I'll answer it in 30 seconds or less maybe. With all the predictions of increased rates next year, how would this affect the fund/portfolio? And I'm answering it because it's fun to think about the different levers that need to get pulled. It's a very complicated question. But we, as I mentioned earlier, we mitigate as much of the interest rate increase as we could. But the answer is, how will that affect cap rates? If short-term rates increase 25 bips, 50 bips, there's still a huge historical spread between the 10-year treasury and cap rates today, right? I mean, today is 200 basis point spread or more. In 2007, we actually saw that spread compressed to negative, where cap rates were below the 10-year treasury. So near-term interest rates, I wouldn't expect to have a meaningful impact on valuations, again, in the near term. That's all I can say about that, because I can only see 1-2 years down the road, and I can't even see that clearly down the road. 10 years down the road, all I can say is we're investing in high quality assets. We're building top tier assets with top tier sponsors and top tier micro markets. And whether interest rates go up, go down, or stay the same, these investments are in a position to be very successful over that period of time.
Yeah, I'm going to add that we are having a lot of internal discussion with our investment management department about using swaps, long-term fixed rate debt, because this is something that we see on the horizon as well. And we have fixed assets and we need fixed liabilities as well. So, unfortunately, construction debt is generally floating. We can do construction to perm. And so we're really considering everything. In QOZ1, it's a lot easier because deals are further along and we're able to put fixed rate debt on those. But you can expect that in this fund, we are going to have primarily fixed rate debt, but maybe not all, because there's always a reason to hold some variable debt. Historically, that's been the cheaper route to go. But we understand that the risk is the higher interest rates, so we don't want a portfolio of variable debt. Thank you for attending. We really appreciate everybody's questions today. We know that we weren't able to get to all of these. Hopefully you took a lot away from this today. You got most of your questions answered. If you still do have questions, just email us. You can email investorrelations@origininvestments.com, restate your questions if you didn't get them answered. And if you have an interest in investing, you can reach out to your contact in investor relations directly and start that process. If you don't have one, you're a new investor, go to our website. You can connect with somebody there directly. You can email us at that investor relations email as well. So thank you for your time. Appreciate it.